expenses charged to profit or loss. This is a critical concept because if these two are mixed up, it can lead to incorrect profit calculations, and that could mislead not just the business, but also investors, lenders, and anyone else relying on the financial statements. What are we really talking about? Every business spends money on different things. Some expenses are for short-term needs, like paying the utility bill or buying paper for the office printer. Other expenses are for long-term benefits, like purchasing a delivery van or upgrading machinery. When money is spent on long-term assets, things that help the business over multiple years, it's called asset expenditure. When money is spent on short-term necessities, things that are used up within the year, it's called expenses charged to profit or loss. The critical thing to understand is that these two types of spending are treated very differently in the accounts. Let's break them down. 1. What is asset expenditure? Asset expenditure is the money a business spends to buy or improve non-current assets. These are assets that the business will use over many years to help it generate income. Examples include machinery used to manufacture products, buildings, such as office spaces or warehouses, vehicles, like trucks or company cars. Think of asset expenditure as a long-term investment in the business. These assets won't just help the business this year. They'll continue to add value for many years. How is asset expenditure treated in accounts? 1. It's recorded as an asset on the balance sheet, not as an expense. For example, let's say the business buys a delivery van for $20,000. This amount will appear as an asset under vehicles in the balance sheet. 2. It is not deducted from income when calculating this year's profit. Why? Because the van will be used for many years, and its cost is spread out over those years using something called depreciation. Don't worry about depreciation for now. We'll cover it later in detail. 2. What are expenses charged to profit or loss? These are the costs a business incurs to operate on a daily basis. Unlike asset expenditure, these costs don't result in something the business will keep or use for years. Examples include utility bills, like electricity or water, office supplies, such as paper and ink, salaries paid to employees, repairs, like fixing a broken photocopier. Think of these as short-term costs, necessary to keep the business running, but not something that will last into future years. How are these expenses treated in accounts? 1. They are recorded in the income statement, also called the profit or loss statement. For example, if the business pays electricity bills totaling $1,000, this amount is recorded as an expense in the income statement. 2. They are deducted from income when calculating this year's profit. Why? Because they are costs of doing business during the current year. What happens if you mix them up? This is where things can go very wrong. If you confuse asset expenditure with expenses, your profit calculation will be incorrect. Here's how. 1. If asset expenditure is treated as an expense, your expenses will be overstated, too high. Your profit will be understated, too low. For example, if you treat the $20,000 cost of a delivery van as an expense instead of an asset, your profit will appear much smaller than it actually is. 2. If expenses are treated as asset expenditure, your expenses will be understated, too low. Your profit will be overstated, too high. For example, if you treat a $500 electricity bill as an asset instead of an expense, it will look like you've spent less money and your profit will appear artificially high. 3. An example to make it clear. Let's say a business buys 10 gadgets for $200, so each gadget costs $20. During the year, the business sells 8 of these gadgets. The cost of the 8 gadgets sold is calculated as 8 gadgets multiplied by $20 each, which equals $160. This $160 is recorded as an expense called cost of goods sold in the income statement for the year. The cost of the 2 remaining gadgets, which is $40, stays in the business as inventory. This is recorded as an asset on the balance sheet and carried forward to the next year. Why does this distinction matter? The key point is that asset expenditure is about long-term value, while expenses are about short-term costs. Mixing them up can lead to errors in the financial statements, and that can cause problems for decision-making. In summary, 1. Asset expenditure is money spent on long-term assets that will benefit the business for many years. These are recorded on the balance sheet and not deducted from this year's income. 2. Expenses charged to profit or loss are short-term costs incurred to keep the business running. These are recorded in the income statement and deducted when calculating profit. 3. Mixing them up can lead to either overstating or understating the business's profit, which can mislead users of the financial statements. If you have any questions, don't hesitate to ask. This topic is fundamental, and understanding it will help you build a solid foundation for everything we'll learn later. Let's understand the question. First, the question is asking us to do two things. 1. Understand what expenses charged to profit or loss are by completing a definition. These are costs for goods and services that the business uses up within the current accounting period. Things that are consumed or finished during the year. 2. Understand what asset expenditure is by filling in a definition. This refers to money spent on long-term assets that will help the business beyond just the current year. Both definitions are incredibly important because treating these costs correctly in the accounts ensures the business reports accurate profits. Answer and explanation. 1. Expenses charged to profit or loss. The correct completed definition is: expenses charged to profit or loss result from the purchase of goods and services that will be used fully in the accounting period in which they are purchased, and so become a cost or expense in calculating the profit for the period. Why is this the correct definition? Let's break it down. Goods and services used in the current period. These are short-term costs, meaning the business consumes them fully during the same accounting period they're purchased. Examples: electricity bills, stationery, or repairs. If you pay your electricity bill in January, that electricity is consumed immediately. It won't benefit the business next year. Charged as expenses to the profit or loss statement. Because these costs are for this year only, they are deducted when calculating the profit or loss for the year. Think of them as necessary costs for running the business day-to-day in this specific period. So, in simple terms, expenses charged to profit or loss are short-term costs used up during the same period they are incurred. 2. Asset expenditure. The correct completed definition is: asset expenditure results in the purchase or improvement of non-current assets, which are assets that will provide benefits to the business in more than one accounting period and are not acquired to be resold as part of normal trade. Why is this the correct definition? Let's break this down. Non-current assets. These are long-term assets that the business will keep and use for many years, like machines, vehicles, or buildings. Examples: a business might buy a delivery truck or renovate its office space. These assets will help the business for multiple years. Not for resale. These assets are different from inventory or goods that the business buys to sell to customers. For example, if you buy office desks, you'll keep and use them for many years. These are non-current assets. But if you're a furniture store, the desks you buy are inventory. They'll be sold to customers in the normal course of business. Used over multiple periods. Non-current assets aren't consumed immediately. Instead, they help the business generate income for many years. For example, if a bakery buys a new oven, that oven might be used daily for 5 or more years to bake products. So, in simple terms, asset expenditure is about long-term purchases that support the business for years, not just the current accounting period. The key difference between the two, the distinction between expenses charged to profit or loss and asset expenditure, comes down to time and purpose. Expenses charged to profit or loss are short-term costs. The business uses them up entirely within the current accounting period, and they are included in the profit or loss calculation for the year. Think day-to-day running costs like salaries or utility bills. Asset expenditure involves long-term investments. The business purchases or improves assets that will provide value for many years, and these are recorded on the balance sheet as assets. Think investments in equipment, property, or vehicles. Let's take a close and clear look at the question and its answers to ensure we understand why each classification is correct. We'll approach this step by step and explain why each item is classified as asset expenditure, expenses charged to profit or loss, or income. Question recap. The question asks us to classify several items as either 1. Asset expenditure. Money spent on long-term assets that benefit the business beyond the current accounting period. 2. Expenses charged to profit or loss. Short-term costs fully consumed within the current year and deducted from income to calculate profit. 3. Income. Money earned by the business contributing to its revenue. Let's now go through each item and its answer in detail. Purchase of premises. Answer: asset expenditure. Explanation: why? Purchasing premises is a long-term investment for the business. Premises are non-current assets that the business will use for many years, possibly decades. This spending is not treated as a short-term expense because the premises are not used up in the current year. Instead, they remain an asset on the balance sheet and are gradually depreciated over time. B. Solicitor's fees in connection with the purchase of premises. Asset expenditure. Why? When purchasing premises, any additional costs incurred that directly relate to acquiring the asset, like legal fees, stamp duty, or transfer costs, are added to the cost of the premises. These fees are considered part of the total cost of acquiring the non-current asset and are therefore classified as asset expenditure. Costs of adding extra storage capacity to a mainframe computer used by the business. Answer: asset expenditure. Explanation: why? Adding extra storage to a mainframe computer is an enhancement to an existing non-current asset. It increases the value or capacity of the computer, allowing the business to benefit from the improvement for several years. This type of cost is treated as asset expenditure because it's a long-term improvement, not a maintenance cost or short-term expense. D. Computer repair and maintenance costs. Answer: expenses charged to profit or loss. Explanation: why? Repairs and maintenance are day-to-day operational costs that ensure the asset remains functional. They do not increase the value or lifespan of the computer. These are short-term expenses, fully consumed in the year they occur, and are deducted as expenses in the profit or loss statement. Profit on the sale of an office building. Income. Explanation: why? When the business sells an office building for more than its current book value, the excess amount profit is treated as income. This profit is recorded in the profit or loss statement as it contributes to the business's overall revenue for that year. F. Revenue from sales by credit card. Why? Revenue earned from selling goods or services, whether paid in cash or via credit card, is classified as income. This is money earned by the business during the current accounting period, and it directly contributes to the profit calculation. G. Cost of new machinery. Answer: asset expenditure. Explanation: why? Buying new machinery is a long-term investment. Machinery is a non-current asset that the business will use for many years to help generate revenue. The cost is recorded on the balance sheet under machinery and not immediately deducted as an expense. Instead, the cost will be depreciated over the asset's useful life. H. Customs duty charged on the machinery when imported into the country. Answer: asset expenditure. Explanation: why? Customs duty paid when importing machinery is considered part of the total cost of acquiring the asset. This is because the duty is a necessary cost to bring the machinery into the business's use. These costs are added to the value of the machinery on the balance sheet as they are directly linked to acquiring the non-current asset. I. Carriage costs of transporting the new machinery from the supplier's factory to the premises of the business. Answer. Asset expenditure. Why? Transportation costs for delivering machinery to the business's premises are also considered part of the total cost of acquiring the asset. Just like customs duty, these costs are necessary to get the machinery ready for use and are added to the asset's value on the balance sheet. J. Cost of installing the new machinery in the premises of the business. Answer. Asset expenditure. Why? Installation costs for new machinery are necessary to make the asset ready for use. These costs are treated as part of the asset's total cost and are included on the balance sheet under machinery. These costs are not recorded as short-term expenses because they contribute to the long-term usability of the asset. Wages of the machine operators. Answer. Expenses charged to profit or loss. Explanation. Why? The wages paid to machine operators are day-to-day operational costs. These wages are not related to the purchase, improvement, or setup of the machinery itself. They are considered short-term expenses incurred to operate the machinery during the current year, and they are deducted from income in the profit or loss statement. Thank you for watching. This was the final lesson from Chapter 2. Keep practicing to master the topic, and don't forget to like and subscribe to support us. See you in the next chapter.